Good morning, everybody. I'm Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at Goizueta Business School. And Happy New Year. And welcome to month, if you can believe it, month 22 of Business Over Breakfast. We kicked this off back in April of 2020 with Professor Tom Smith, helping us sort out the effect of the pandemic, what the effect of the pandemic was having for ourselves personally and also for our organizations. And our goal was to help us move from survive to thrive. We had no idea at that time that that journey would take us through a lesson in the Greek alphabet. So I hope you and your families and your communities, your organizations have stayed healthy and safe over the holiday period and continue to stay healthy and safe. The team has been working hard on pulling together a diverse set of faculty for Business Over Breakfast for 2022. And I invite you to make sure that you put the first and third Thursdays of the month on your calendar and invite your colleagues to do so as well. One thing I really appreciate about the Goizueta faculty is their ability to bring both the academic rigor of research and couple that to the practical application so that people like me, people like you could actually use that in both our lives and in our work environments. So more to come, but just wanted to alert you to making sure you put that first and third Thursday on your calendars. It's my pleasure to once again introduce Professor Tom Smith, who is one of those faculty who just connects the research to the practicalities and does so in an amazing way. Tom is a professor in the practice of finance, and he is an expert in labor economics, pricing, sports economics and financing, the economics of the entertainment industry, and healthcare. He regularly appears as an expert on national television and radio, and is frequently quoted in the press regarding trends on unemployment, inflation, and trade. So Tom, welcome. There is a lot going on in the economy today.
A couple things going on.
Yeah, just a few. So it's going to be fabulous to hear your insights on what's happening and then answer everyone's questions. So please,
Go on. So let me ask you, when you say like, okay, there's a lot going on, like, what's the first thing that you think about when you're thinking about the current state of the economy?
Interest rates and employment rates.
Okay.
Of course, there's the whole pandemic. Is it going up? Is it going down?
Sure.
Sure. That trigger. But those are the two things that I that come to mind first off. There's a bunch of others as well, but.
Yeah, I think that's a really good point. And so when most people right now are saying inflation, employment, and then they're interested in what's going to happen with interest rates with respect to the Fed. The Fed is meeting next week. So let me walk through some of these things. Like, I want to make sure that it's like when I'm talking about the macro economy, that in stock market performance, someone's mentioning stock market performance. Yeah, the market is in a huge flux right now for a lot of good reasons, right? So I want to make sure that I'm talking about the areas of the economy that really play into how current business owners are thinking about what is the state of the economy. It doesn't make a whole lot of sense to talk about esoteric economic metrics that don't really impact anybody. It's important to understand how the major forces are playing into sort of how we go about doing business day to day. Okay. Right. So when I'm talking to people,
Tom, why don't we invite people to do what Alicia has done and put some topics that they're interested in to the chat?
Yeah, please. Yeah, please go ahead. Please go ahead.
And then just a reminder, please put your any specific questions into the Q&A, and the team will help Tom answer. We'll get to those questions and answer them.
Long-term growth, GDP.
Over to you, Tom.
Okay. All right.
Thanks so much.
I've got a bunch of metrics that I put together as part of a report with one of my colleagues here, who's joined me in the past. And so I was invited to come and do this solo today, and that's fine. I did kick this thing off a couple of years ago when the pandemic first started. So, and I'm seeing some of the charts, things like GDP growth and unemployment in the chat, things of this nature. So I wanted to share with you this. So as we know, a lot of us are keeping track of it. A number of us have stopped because we just don't have that kind of space in our minds. But COVID is sort of first and foremost why it is that we're in the economic state that we are in. And as Dean Nicola mentioned, we're going through the gamut of different Greek letters, the Delta and the Omicron and the Gamma and this and what have you, right? So, this spike that we're seeing with Omicron is it's very, very dramatic. I've heard some people refer to it as a pencil spike, that it's going to go straight up and it's coming straight down. This is the trend of new cases as well as the 7-day moving average. For the United States, the 7-day moving average is still going up. For Georgia, Alabama, Florida, the 7-day spike has just started to move down a little bit. It sort of depends on how it is that you're measuring and when it is that you are releasing the numbers. Florida has changed how it is they release the numbers. So you might see the moving average actually go down. And then when they revise them, it actually starts going up again. And so it's always a little bit misleading because of how they actually report the number of cases. But so we're seeing this downward. Let's say we've hit the top of the spike, maybe in the Southeast, but other parts of the country are still seeing the spike going up. And just read yesterday that if you look at counties, urban versus rural, it also says essentially two different things. And that is in urban areas, the spike is already hit and we're starting to go on the downward trend of that. But in rural areas, it's starting to spike up again. It really speaks to the sort of mismatch with respect to, let's say, testing, with respect to getting vaccinated, with respect to how this thing spreads and how close proximity people are and where it spreads and what have you. And so there really is this disconnect between states, cities, environments, and then rural environments, and when this thing is going to hit its peak and start trending backwards. I don't think that this particular strain is having the same kind of impact as we've seen in other strains, but it still is creating some kind of discouraging mechanism so that some people are not entering back into the labor market. And that's where things start to fall apart when it comes to our economy, is that we have this huge mismatch in the labor market. Now, I know some people, when on the chat, we're talking about GDP growth. This is a chart that looks at different spikes in different states. I'm looking at the Southeast, particularly Florida, really, really high spike. In Georgia, we had the highest spike. Places like Louisiana and Mississippi, which had lower number of cases overall, still had the highest spike with Omicron. And so there's still more cases with Omicron than we had with the other variants. When it comes to this mismatch here, there's two things I wanted to point out here with respect to these vaccination rates and vaccinations and employment, actually. So I looked at the relationship between the vaccination rate and the unemployment rate, and also the vaccination rate and the labor force participation rate. Now, the reason I'm doing this is because there is this mismatch between people who want to work and are working and the needs of businesses. So I'm seeing businesses having needs for people, at least they're saying that they have job openings, and they most businesses right now that I am talking with have lots of difficulties actually getting a good candidate for the jobs that they have available. So that maybe they can't get the right candidates. Maybe they're not sure if those candidates are really going to work there. Even if they do work there, some of them are bugging out after a couple of days. It's a very strange labor market right now. Lots of discontinuities. So I was thinking, okay, what's going on? What the underlying cause here, of course, is COVID. So what's going on with respect to vaccination rates and unemployment rates? Now, the states that have the lowest vaccination rates also have the lowest unemployment rates. You'd say, does that make sense? Is it past the sniff test? I think it does. So states that where people are saying like, I don't really care, or it's not going to impact me, or I don't really believe it, or what have you, are also more willing to enter into the labor market in some respects, and they're filling jobs quicker. So Alabama, Georgia, Arkansas, Mississippi, Louisiana all have lower vaccination rates, and also, at least Alabama, Georgia, Arkansas, Missouri have lower unemployment rates. So, Georgia's unemployment rate is, hanging around 4%. I mean, it's really pretty low, right? Well, 3 and change, 3 and change, right? And so, there's something there, right? So like, and the states that have, let's say, higher vaccination rates have a lot of hesitancy, and people are sort of coming in and out of the labor market. That's the second part here. This is the labor force participation rate. The states that also have the lowest vaccination rates have the lowest labor force participation rates. The labor force participation rate is the number of people who are working relative to the number of people who are eligible to work, or the number of people who have said, I'm either willing or able to work, and have put themselves in the labor market. They're looking for jobs. So you're either employed or unemployed. All right. And so the fraction of the population that has put themselves back in the labor market, now that's the labor force participation rate, is the lowest for states that have really low vaccination rates. So we may have really low unemployment rate in Georgia and Alabama, but we also have the lowest, or some of the lowest, ratios of eligible workers actually entering back into the labor market. So those are the states that I'm most concerned about, because there is this demand for workers from businesses, but there is a hesitancy of workers getting back into the labor market. And the states that are more vaxxed, higher percentage of the population that's vaxxed, are also seeing a higher percentage of their eligible population go back into the workforce. So those economies, the ones that are higher vaxxed, are actually going to be running smoother in the long run than these economies that are less vaxxed. So there's this disconnect. And I mean, we're talking about, there's lots of levels of disconnectivity, but I think this is a primary level where businesses are looking for people and they cannot find people to occupy those jobs, right? And that seems to be most prevalent in the states where you have the least number, or the lowest percentage of your population that's vaccinated. I think that's going to be trouble in the long run, right? In the short run, you say, who cares? I mean, unemployment rate in Georgia is 4%. But you've got a huge number of people who haven't gone back in the labor market. What happens when they do? Well, the unemployment rate's going to shoot up. And that is very, very troubling. So first off, it's like, okay, is it likely to get more people vaxxed as we go? I'm not sure. It seems like everybody who wants to get vaccinated is getting vaccinated. So I don't know what the next step is, because COVID's not going away. So, how do we encourage people to enter back into the labor market, to make them feel safer, or they've got some kind of opportunity cost that's keeping them out? Not clear what the solution is here. And I know it might be helpful for you to say, look, you're pointing out a problem, but you haven't figured out the solution. We're still trying to, crack this nut with respect to getting people back into the labor market. One of the things that I've seen, and which also troubles me with respect to the labor market, is the number of people who have applied for new business licenses. I'm going to skip down on this thing. I know that probably annoyed some people here. This, I want to show you this number of people who have applied for business licenses. So we had this huge spike in the number of people who applied for business licenses after the pandemic, and it has remained much higher. And we've seen this also in like states like Alabama, okay, in Florida. All right, there's just a huge number of new business licenses came after the pandemic, and they've stayed much, much higher, like 30% higher than they had been for essentially the previous 10, 20 years. Okay. And so I did a story on, I don't know, national news about, people resigning from their job and then starting up their own business. Ordinarily, this wouldn't be problematic, except for this spike and all these people who have said like, okay, I'm going to go into business for myself. Great. Except for, depending on some of the statistics you look at, somewhere between maybe 20% and 50% of new businesses fail in the first 2 years, depending on the business. For, let's say, restaurants, the statistics say that it might be upwards of 80% of new restaurants fail in the first 5 years. So, the economy, the market is not kind to entrepreneurs. It is tough, and new businesses are not very successful, or it takes a long time for them to become successful. Clearly, we have examples of people who start a new business who are successful right off the bat. But if you've got failure rates of somewhere between 30 and 50% within the first 2 years, this is troubling. Why? Well, in the last year, we had like 5 million new businesses start. Okay. Well, let's suppose that only 25% of those, a quarter of those fail, right? So that's been about 2 years. Okay. So let's suppose a quarter of these fail. Well, now you've got 125 people, assuming each business has only one person, which I don't think is a real good assumption. But if each business only has one person, sole proprietorship, you're talking about 1.25 million people who now have just blown through their savings, right? Don't have any capital, probably are defaulting on a loan. And now they're going to enter back into the labor market because they don't have a job because their business just failed. That's going to be problematic. And if you say, okay, well, they're not all going to enter into the labor market at the same time, they're going to trickle in. Maybe, they all jumped out of the labor market and started a business at the same time. And so it wouldn't be unreasonable to think that at some point, lots of businesses could fail at the same time. Maybe February, March, maybe this spring, right? Like all of a sudden, like, wow, lots of businesses that sole proprietors all of a sudden are realizing that this is not the easiest thing to do, is run your own business. So we could have a lot of failures. And even if it's just a trickle, this is not like a drip, drip, drip of an old faucet. This is more like, turning a tub filler on. There's going to be a lot of people who now don't have savings and are defaulting on loans. That's problematic. So it's very possible that at the beginning of this next year, so we're in start of quarter one. It could be that by the end of quarter one, start of quarter two, we start seeing a bunch of people who had businesses enter back into the labor market. We could actually see the unemployment rate start to increase, because these people aren't going to have, a bunch of savings, a bunch of opportunities to do day trading on cryptocurrencies anymore. Their savings are gone if their business has failed. So that, I think, is the big scare that I am looking at. I'm not confident that all those people can make a good go at it, unfortunately. That's me saying statistics in the past are going to predict what's going to happen in the future, but there's nothing about the way that these businesses are designed or came about that would suggest that 25, 35, 45% failure rate is going to change. So if somebody can point me to a statistic that suggests that they're much different than previous new businesses, I'd be willing to look at it, but I haven't seen any evidence that it is. Okay. Let me talk a little bit about just sort of some general trends so that we can get a sense about, like, say, perhaps some policy actions that are going to take place. Someone talked about real GDP. So we had an economic recession, and the economic recession started in essentially March, April of 2020, and it was over in 2 months. I mean, according to the Business Cycle Dating Committee, they're the referees of the economy. They're the ones that call economic recessions. So we had a 2-month recession, and then now we're out of a recession. We're still not seeing huge, robust growth. I mean, we did see this huge spike in real GDP growth because we had fallen so far down. You're likely to see a spike, and GDP growth is, somewhere between 2 and 3%, 1 and 3%. This last quarter, it was pretty meek. I think that the economy is not moving forward. People are really, really, really hesitant about making plans. The businesses, I think, are really hesitant because they can't find workers. And so I think the economy is just kind of like going to chug along at a really, really, really low pace. I am scared that if we see this huge influx of people who have new businesses and those fail, that the economy could actually hit a wall. Like nobody's going to know exactly what to do. You might say, well, there's job openings for all these people, but filtering through all of those people to try to figure out if they match up with the job that you need them to do, if they have a skill set, I think is going to be incredibly challenging for people in HR and, trying to look at your quality of your workers. You're going to have a lot of noise. The other issue that Dean Nicola was talking about with respect to interest rates has to do with inflation. And so we're currently, news just came out that we're having 7.2% year over year inflation. So from December to December, right? So 20 to December 20 to December 2021, we had 7.2% inflation. That's the highest inflation we've had since the OPEC oil embargo in the early 1980s. And so everybody's saying like, oh, this is near record-breaking inflation. Well, it's certainly the largest inflation that a lot of us have experienced. And I mean, the highest inflation that some of us have experienced ever. This is very challenging. It's very, very difficult to run your business going forward if you don't have a good sense about where prices are going to be. Now, of course, along with this, inflation is going to have upward pressure on wages. So we're having some wage inflation. A lot of that has to do with this mismatch between the need of employers and the desire of employees to go back to work. What does that mean? 7% inflation. Is that sustainable? Absolutely not. We cannot have 7% inflation last for any long period of time. It's already been longer than some economists have predicted. They were saying it was going to be transitory. It certainly is not. It is here. So the Federal Reserve was scheduled to meet next week on the 25th and 26th of January. They are going to increase interest rate targets somewhere between 25 and 50 basis points. You say, what does that mean? So the Federal Reserve will make a release that says we have increased our interest rate target, our federal funds rate target, from basically 0 to either a quarter of a point or a half of a point. They might then also increase the discount rate. That's the rate that the Fed lends to banks directly, also by 25 basis points or 50 basis points. So a quarter of a point to 50 points. See, how does that impact the average Joe on the street? Well, the Fed sets this federal funds target, and then what it does is it's going to remove cash from the economy. So it's going to back off. It's already stated it's backing off its quantitative easing. So it's going to be pulling money out of the economy, which then makes it more expensive for banks to lend to each other, which then makes it more expensive for banks to lend to consumers and businesses. And so even though the Fed doesn't set interest rates on mortgages and car loans and new business loans and home equity loans and things of that nature, that it is all part of a ladder. And so when the Fed sets their federal funds rate target, then all of those other interest rates sort of line up on top of that. So they're not exactly parallel, but they do line up on top of that. And so it will be more expensive to get money, to borrow money. this will slow the economy down. The trick is for the Fed to control inflation without throwing the economy into another recession. I'm not sure that it can be done easily. In 1982, Paul Volcker did the same thing, but he threw the economy into a recession in order to combat, double-digit inflation. And we had a very, very nasty economic recession during Ronald Reagan's second year in office. It's called the Paul Volcker recession. So I think that our central bankers have learned quite a bit since then, and they understand that they can make very, very small movements, right? I mean, there's a difference between a Formula One driver, Lewis Hamilton, and a student driver who's making, very, very dramatic turns in the economy. I mean, these are Formula One drivers that we have at the helm of the Federal Reserve now. And so they can make small adjustments as they go, right? And be looking far ahead to see what's likely to happen. And they will make small adjustments. All of this, what they did this last couple of months by saying, well, the Fed's going to wind down its quantitative easing. The Fed's going to start doing this. The Fed's going to start doing this. This is all preparation for what they're going to do next week. I don't know. There's some questions out there, Lauren. What do we got?
All right, Tom. So first we have, let's see, are most of the new business licenses because people are being entrepreneurial or because they are increasingly forced into contract work?
So say that again. You cut out for like 1 second. I apologize.
Oh, okay. Can you hear me now? Is that better?
Yes. Yeah.
Okay. Are most of the new business licenses because people are being entrepreneurial or because they are increasingly forced into contract work?
So when you look at the new business license applications, you can't actually read the application. So you just see that there was a spike in applications and there's a lot of there's new businesses. I think that when you look at the number of businesses and the relative size of businesses, most new businesses are in the 1 to 5 person category. So it's difficult to know if someone's being an entrepreneur or if they no longer have a job and now they're forced to act as a contractor or sole proprietor. If you are acting as a contractor or sole proprietor, you probably should register yourself as a business, as an LLC. I don't know if everybody, like in 2008, we didn't see that happen, right? So people lost their job at Coca-Cola, but then they were rehired as a contract worker at Coca-Cola. So I'm just picking Coca-Cola, for example. And then the business Coca-Cola can save on healthcare insurance and 401ks and all of that. Well, we didn't see a spike in new business applications during that recession, but there were a lot of people who were doing contract work. So I don't think that most of these people are saying, oh, okay, now I've been fired by my job. I have to do it. I'm now an IC. Oops, but the law says that I have to be an LLC. I just don't think so. I think most of this is people are being entrepreneurs, quite frankly. And that's what is troubling to me, is that there's going to be some very nice successes, no doubt, right? And so I'm certainly not saying that every business is going to fail. Not every business does fail, but a large share of them do, and people don't know how hard it is to run your own business. And so there's a lot of people who jumped into the business because they said, well, I don't want to work for someone else during this pandemic, so I'm going to go work for myself. Great, good for you, be an entrepreneur. But a lot of people are going to say, like, oh my gosh, I had no idea. Like, I'm the one who has to take care of all this and get up at 6 a.m. and, work my fingers to the bone, and it's just not worth it. And they can't make their payments, and, and then all of a sudden they're like, oh my God, I just blew through all my savings. Yep, that's the problem that I'm anxious about.
Thank you, Tom. Another question. Any thoughts on how the Fed will deal with crypto or other digital currencies, which may detract from the USD and add new instability?
So, I mean, the Fed, the Federal Reserve, doesn't really oversee cryptocurrencies because it's not a real functioning currency as a currency in our economy. There are maybe 2 less developed countries that have identified that a cryptocurrency is their currency. But I haven't seen more than maybe 2, maybe 3, but it doesn't behave like a currency the way that most people would think about it as a currency. So I think about it more like an investment. So it's an asset and highly volatile, clearly, and very speculative. And all of our attempts or other people's attempts at, let's say, mainstream different cryptos and having people use cryptos to actually transact haven't had the traction that they anticipated. And I think that it's going to remain a curious investment for a lot of people. I do think that it has, you can see that it has wild swings, and people are clearly investing in it, especially millennials are investing in it, Gen Zs, all of the newer investors thinking that this is a great way for them to build huge amounts of equity really, really fast, because we can grab onto one of these cryptos and it can explode, by a couple 100% in a few days. And you're like, oh, okay, now all of a sudden I'm a deca millionaire or something. Oh, and then 2 days later, you've lost all of it. That's just nuts. I don't think the Federal Reserve monitors it more than just understanding it. But I think that it's here to stay. But I think about it as an investment, very speculative. Some of the research indicates family lifestyles changed due to the pandemic, create a new way of working more conducive to their family needs. Linda, absolutely. So Linda mentioned that there's research that shows that people are changing the way they work. Yes, I believe that this is adding to the labor force participation rate and the decreased number of people who are entering back into the market. People are reconsidering what their family means to them or how it is that they go about doing work. Okay, do you really want to get up at 6 and drive an hour and stay there till 5:30 and drive back and miss your kids' soccer or piano or ballet or whatever else? A lot of people are saying, no, thank you. Let's figure out a way that we can make our family work with maybe 1 income or 1.5 income. Maybe I can do some consulting on the side or what have you. Here is the problem with that right now, is that this near double-digit inflation, 7% inflation, I think it's going to be closer to 5% for the rest of the year, is making it increasingly difficult for a family to do any kind of budgeting and forecasting about what their expenses are going to be for the next year. Even families that are reeling from the fact that a lot of rental costs went up by huge amounts. So 25, 35, 45% increase in people's rents. And so my daughter, who lives over in Milton, I think her rent increased by almost 25% in a second. Like the guy just called up and said, oh, I think I can get this much now for my house. And he said, I looked at the comps, and so that's how much it costs. And she doesn't have many choices. Well, she certainly doesn't want to move back in with her folks, right? At least because she's got a family. So she said, what am I going to do? I go and look at the comps, and he's right. There's 2 other houses for rent in this subdivision, and they're both at the price that he quoted. And my kids already go to this school, and it's January. And what am I going to do? Pull my kids out of this school and have them start in another school and try to find a new rental house? That's going to take me months to do that. And there's no guarantee that I can get a cheaper house. You're right. She couldn't. So she's like, okay, what am I going to do? Like, I got to pay 25% more on my rent. Now what? Okay, that is a real concern, Linda, is that families are going to be faced with these very quirky, huge spikes in some of their costs, which is going to have them reconsider whether or not somebody really can stay home, or whether somebody can do kind of piecemeal work or do sort of a side hustle, or whether the side hustle becomes their main hustle. And at some point, they're going to run their numbers and say, oh my gosh, like the side hustle isn't getting it done anymore. And it's now I need to actually go work for somebody else. So I think that's what you're saying is true. I also think that there's a challenge, and the challenge is that it's hard to make a side hustle work if you've got even 5% inflation. Other questions? I know there's a lot of people who mentioned some stuff on the chat here. Let me see. Was there some research? That was somebody. Todd has a question here. Interest in inflation, manufacturing costs up 40%. A leading indicator of continued increasing inflation shows that inflation is going to continue for a while longer than expected by economists. Okay, so this economist, Todd, is a great point. This economist is saying that we're going to have inflation through the whole rest of this next year. So a 5% inflation doesn't mean that prices are going down. It means that they're going up, but they're going up at a slower pace than they currently are. So currently we saw inflation of a little over 5%, and then it went up to 6%, then 6.5%, and then 6.8%, and now 7.2%. So prices have been going up, and they've been going up at a higher rate. So we're seeing prices go up, and they're going up faster. So when the Fed intervenes next week, then what's going to happen is that we're going to see prices go up, but they're going to go up slower. So inflation is going to be probably not for January, but maybe at the end of quarter 1. So quarter 1, April to April, or May to May, it's probably going to be closer to 5%. We're probably looking at a year of, somewhere between 4 and 6% inflation for the whole year. I believe that the Fed is going to make 3 different movements. They might do them back to back to scare everybody into like slowing down their purchases. And so I would be surprised if and they've done this before, if they do a 25 or 50 basis point increase next week, and then 3 weeks later, bam, another 25 basis point increase. Everybody's like, what? I didn't expect that to happen. Those are the policies that seem to have some traction, is when the Fed can make a move that's a little bit unanticipated. So they said that they're going to make moves, and I anticipate 3 movements this year. I said next year, I apologize. It's this year. I expect that they're going to make 3 movements, but they might make them in relatively quick succession, bum, 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 or they might make 2 right away and then wait. Pacing it out, especially in a way that's predictable, I think is going to take away some of the power that they have. And some of the power is like a little bit of shock and awe, if you will. Do you have other questions?
We do, Tom. So does labor force participation take into consideration gig workers?
Does the labor force participation rate, it depends on how people are self-reporting this information. So, so gig workers are working. So, what happens is the Bureau of Labor Statistics calls people up and asks them about if they were participating in work for pay outside of the home during the reference week, which is the week of the 15th. Okay. And so if you say yes to these things, then you're qualified as being employed. So now you're in the labor market. If you say no to these things, then they ask you follow-up questions. Were you looking for work? Were you actively seeking, going to job boards, sending your resume out, and what have you, right? Then you would be in the labor force, but you would be unemployed. So the labor force is comprised of employed and unemployed workers. So gig economy workers would be counted in that. By and large, it depends on how people answer those questions. But if you say, what if there's like a stay-at-home dad who's like, his spouse is off working, he's staying at home, but he's also, I don't know, doing some kind of like knife sharpening or something on the side. Okay. And so if the BLS calls him up, if he's going to say, no, I'm a stay-at-home dad, no, I'm not really working for pay outside the home, he decides to be a little bit coy about it and say no, then, he's just not even in the labor force. You're like, well, he's kind of in the labor force, like he's doing something. He's a little bit of an entrepreneur, he's got his own job or whatever else. Is there evidence that there is consistency with respect to a group of people who consistently say they're not working when they actually are? Or is there consistency about people who are saying they're working when they actually aren't? There is no evidence that gig economy workers, by and large, hide their trade any more than anybody else does. So there's just so the answer to this is the labor force participation rate should capture anybody who's actually working or looking for work, which includes gig workers. You probably didn't need all that.
Thank you, Tom. Very helpful. So 2 questions kind of combined. So what are your thoughts on returning to the office in person this year? And what will costs look like over the next year? Do you have a graph?
Do you have a graph for costs? I have a graph for wages. And I mean, costs are part of wages, right? So, or wages are part of costs. So nominal wages are going up. Well, energy prices are going way up. Okay. I'm anticipating, so this is an ARIMA analysis. I used the backwards numbers to make forecasts going forward, which is very standard statistical analysis. And so I had this unemployment topping out, and this band here, excuse me, this is inflation. This band here covers like 1% and 2%, deviations, 1 and 2 standard deviations here. But this thing says that you could have inflation up as high as maybe 8.2%. We have not seen the numbers for January, right? So, everybody thinks if the Fed's going to make a move at the end of January, then we're going to see inflation start going down. Well, at the beginning of February, we're going to get our January over January numbers, and they could be 7.4%. They could be 7.6%. I don't think they're going to be less than 7%, but they could be like 8%, right? So this is my forecast for, let's say, inflation, which then translates into, let's say, long run costs going up, but going up at let's say, a slower pitch. We have an upward trend in wages because there is a mismatch between workers and employers. And whenever there's a mismatch between workers and employers, then employers are forced to pay higher wages to either attract or retain the workers that they want. There was just an article I talked on the news yesterday about Governor Kemp having a $5,000 raise for government workers. And the question that was asked me was, is this going to be enough to stop this transition of people away from government work? And it's not clear that it is. It's probably moving in the right direction. That is, there's probably a huge mismatch between what people think that they deserve working for the government and what they're actually being paid working for the government. And so a $5,000 increase in wages is getting closer to the equilibrium wage. Will it be enough? Not clear. I think people are realizing, as one of the one of the people in the chat said, they're rethinking how it is they want to spend their time. And not everybody wants to spend their time commuting and sitting in an office. Let me get to this part about the cost here. Let me see if I've got a figure on wages here. So here's the consumer expectations for inflation. So consumers expect inflation to go up. And so this is out of University of Michigan, one of their consumer expectation surveys. And this is earnings, real hourly earnings. So you'll notice that if we look at nominal wages are going up. I don't think I have a chart of nominal wages here. Nominal wages are going up, but they're not going up at the same pace as inflation. So because we have this 6 and 7% inflation, real wages, which is your nominal wages adjusted for inflation, are going down. And so we're seeing here, look, these are different industries. In just about every single industry, the real wage recently has been trending downward. But so even though nominal wages are going up, inflation is taking away the buying power and it's forcing real wages down. So here's what you have to consider is that businesses are going to have to reconcile with their lack of employees and figure out how to attract the best candidates, which means that they're probably going to have to increase wages. So they have to add that into their overall cost structure. I know I saw in the chat there from Todd W is saying, look, sometimes he has to build out 2, 3, 4 years in his production schedule, and he's locked into prices. And my next door neighbor, who sells plastics, he's saying, look, yeah, they do the same thing. Like they get in a contract with somebody and he says, okay, fine, here's what the prices is for delivery of this many plastics over the next whatever X number of quarters. So now you're locked in. And if they're seeing inflation, then he says, look, we've got a little bit of unanticipated. Well, we've had some unanticipated inflation. So now we're going to build in some inflation expectations. So we're going to be charging you 8% more in Q3 or 10% more in Q4. I mean, I don't know if he's doing those numbers specifically, but he is forced to sort of push those costs forward. So then the company that's buying the plastics is saying, okay, if I'm paying 10% more for plastic pellets, then, and that's part of my production for Q4, then I got to think about pushing my prices out by 11 or 12 or 13% to make sure that I still have a profit margin. So now you're looking out and saying, like, goodness, because of these supply chain issues and because people are getting locked into some kind of a payment schedule, then they might be forced to have higher prices a year from now. And I think that that's absolutely the case, is that the inflation is not all of a sudden going to go away. It's not going to go back to zero. It's not going to be at 2%. It's going to be at 4, 5, 6% for the rest of the year and easily into 2023. I think it's going to be a while before we see prices go back down to, that is, inflation go back down to 2% or 1.5%. We were very, very, I would say, lucky with respect to inflation. After the 2008 recession, the Fed dropped interest rates all the way down to zero, and everybody was predicting, not everybody, but a lot of people were predicting huge inflation, and we just didn't see it. But that's because banks didn't loan, and people were waiting for the second shoe to fall. And so there was lots of hesitancy in hiring. And because of the way that recession happened, people were scrambling for jobs. Like, just give me anything. I'll do twice the amount of work for half the pay. Like, just don't fire me. But now people are like, whatever. I've got money to relax on. I've got all of this fiscal stimulus that came in. I've got extra unemployment rates, and I made myself, 10 grand on cryptocurrencies last year. Geez, I'm rolling high. Like, I can afford not to work. All that savings is going away. So, people are going to have to work. I don't know. I'm talking about like 14 different things at the same time. Goodness. Lauren, you asked me about going back to work, back to the office.
Yes.
I know that a lot of companies were saying, okay, you're right. But like Jamie Dimon was saying, okay, you got to go back. We're going to be back in August. Okay, maybe we're going to be back in January. Okay, maybe we're going to be back in March. I think some businesses, they've just said, we're just never really going to be a brick and mortar business ever again. Okay, I know lots of people who are working for brick and mortar businesses, and they're like, yeah, we're just pretty much all now just working at home, and we're still being very, very productive. Clearly, some businesses are going back to work because that's the only way they conduct business. I mean, you can't not be at work at Chick-fil-A or something like that. I mean, clearly. Is it safe? Is the question. Do I like going back to work? I mean, I love being at Emory. I love being in front of my students. Is it safe? I mean, where I work, there's mask mandates and vax mandates and boost mandates, and everybody's masked up, and everybody is, and they've got a social contract going on. I mean, everybody is trying to be, aware of each other's situations. And so, but I can't say that that's true for every workplace. Probably it isn't. So, I mean, people have to just be vigilant. If this is something you care about, like making sure that you're healthy and staying healthy, then you just have to be vigilant and just be like, really take care of yourself. So even if you're in an environment where it's very, very, very difficult to do that, you have to figure out ways where you can sort of safeguard yourself. Other questions, comments, thoughts here?
Yep, we have a couple more here, Tom. So what percentage of the inflation do you believe is transitory?
I don't think any of it is transitory. So the people are talking about the inflation being transitory, and that we saw these. So let me give you some examples of some transitory inflation that we did see. Okay, I don't want to be too glib or smug about these answers because they really mean things. So when we saw this, let's say, a relief in the pandemic, and everybody thought, oh, okay, like everything is all good, right? Then everybody decided to go on vacation, and we saw this huge spike in rental car prices, especially out in Vegas. And I'm sure you can find an article about somebody who had to drive around in a Ryder truck for a week because it was cheaper than driving around a Ford. Okay, and then 3 weeks later, that was done. Well, that's a transitory inflation, right? And we also saw lumber prices spike up. Man, it cost me $3,000 to have part of a fence built. It was ridiculous, but that's what it cost, right? And they spiked way up, and now they've come back down. Those are the transitory elements. And those things absolutely happen when there's a crazy mismatch in a market, this huge spike in demand, in addition to some kind of a decrease in supply. Okay, but those things are part of the inflation calculation, but it's not all of the inflation calculation. The inflation calculation looks at this huge basket of goods, 400 goods used by 90% of urban consumers, and they track the price of these goods month over month over month over month. And by looking at the exact same goods, now you're capturing overall inflationary trends. There are plenty of reasons why people shouldn't believe inflation based on a CPI or a GDP deflator, because you can do substitutes and what have you, right? So 7% maybe overstating it because you can substitute away from some goods and other goods, right? But that 7% is capturing the movement in prices of 400 plus goods. Well, that's not just one blip and weird car prices in Hawaii. Okay, that's a lot of goods all showing upward trends in prices. And so I believe that, like, when it says the inflation rate is 7%, like, okay, that's capturing overall movement of prices. Do I think that there are some goods that are contributing higher or less? Yes, clearly, like oil prices or energy prices have spiked way up since the beginning of the pandemic. Remember, at the beginning of the pandemic, nobody was driving, demand fell, and price of gasoline tanked, literally just went to zero, or they were paying you to take delivery of oil at one point. It was ridiculous. And so if you look at the year over year changes in gasoline, it looks like we've had, like, let's say 30% inflation on gasoline. Well, that's because prices fell so low, right? But you can look at inflation with or without energy, with or without healthcare. And regardless of whether you're including energy or healthcare, you still have a chunk of inflation, 5-6%. I think that this isn't going anywhere. Now that we've experienced inflation, it's given permission for businesses to increase their prices to offset the higher wages that they're going to have to pay to attract workers. There's something called a wage price spiral, where it's you have to pay your workers higher amounts of money to attract them, and then the business has to increase their prices to cover those higher costs, which then, since the higher prices, the buying power of your workers' dollars don't go as far. So now they actually ask for more money. And if you're willing to give it to them, you're only willing to give it to them under the condition that you think you can raise your prices of your goods even more. Hence the spiral. And so you get into this very, very nasty loop where you're saying, like, okay, I'll raise my prices to cover my wages. Now my workers want more money because prices are higher, so I'll raise their wages, but I got to increase my prices too. Now your workers want more money to cover prices which are higher. Very, 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 very nasty. The only way to take care of that is, like, really strong action from the Fed. Raise interest rates by a ton, interest rate targets by a ton. Other questions?
So I think we have time for one more, Tom. And
Okay.
This one is, will all of this be followed by a recession to correct the markets, like back in the late 70s, early 80s with the Carter administration?
So we got to think about a recession is not just a corrective mechanism, right? You don't, like, oh, the economy is going to go into a recession to correct itself. The economy goes into recessions because there is an economic shock that forces part of the market to closed down, right? So in 1979 and 1982, 1979, it was an OPEC oil embargo. There was the fall of the Shah of Iran. So there was a oil price shock, supply side shock, which pushed up the price of doing business. Because there was an oil price shock and the Fed had relatively loose monetary policy, you had double-digit inflation. So we had a recession, economic recession in 82 that was caused by the Federal Reserve to fix inflation. But that was necessary to fix inflation. Economic recessions don't normally happen to fix a broken market. They happen because there is a shock to the system. Like our economy was just cruising along just fine until the pandemic just froze everybody in their place. So what we have going forward is this. We've got workers who are very, very hesitant to go back to work. We have businesses that are scrambling desperately to find workers who can fill those positions. We've got very loose monetary policy, which has now caused inflationary trends. And we've got lots of uncertainty with businesses, which is now causing, these markets to be like hemming and hawing. The economy is not currently in an economic recession. I do believe the economy could be pushed or might be pushed into an economic recession because of this huge number of people who have their own businesses and are likely to fail. I do not want them to fail. It's just historically somewhere between 20 and 50% of new businesses fail because it's a lot of work. All right. So there will be business failures with an unprecedented amount of new businesses. Even a small failure rate of these businesses will be millions of people entering back into the labor market in the next 6 months, which is insane. I mean, when you think about like the total number of millions of people who aren't in the labor market, and then all of a sudden it's like they're going to be in there. And if you say, no, it's going to be drip, like 100,000, 100,000, 100,000, 100,000. Well, this is still like, when you think about that, how many people are not in the labor market, even a small dripple, of people coming back in will be very destabilizing. And so I think there's a potential for us to go into an economic recession this next year because the market we're not on solid footing. Like we're so not on solid footing. Nobody knows how they're going to find workers. A lot of doom and gloom. I'm sorry, Jerry, or Gary. I mean to mispronounce your name. I'm not trying to be that guy, right? And I'm not trying to say like, oh, everything is awful. Everything is clearly not awful. Lots of things are very good. I'm just being, let's say, pragmatic, and I'm being realistic. So I don't want to be bombastic, right? And I'm not trying to be like a shock jock. What I want to do is I want to prep everybody for the fact that the economy is not perfect. These mismatches and this uneven footing is something that we've never experienced. And what it means is that we've got to be aware and we have to plan for the fact that we could be entering into an economic recession this next year. The Fed's going to increase interest rates, and firms are going to figure out what that means. And they definitely could slow down production, and they might not be hiring everybody that they've got opening spaces for. So I think that that's problematic. There we go. Let's leave you on that. What a great note. Yeah.
Beautiful, Tom. Thank you so much. We do appreciate you. And thank you for kicking off this 2022 Business Over Breakfast webinar series.
My pleasure.
Thank you it's really just a wonderful morning. So thank you. Everyone, thank you so much for your participation and attendance this morning. Great questions, very engaging. So look forward to the spring 2022 topics. We have strategy visualization, analytical finance, leveraging mobile data, and many, many more. So stay tuned and join us on the first and third Thursday of every month at 9 a.m. Eastern Standard Time. We also have, let's see if I can get this to advance here. We also have some upcoming short courses. We have strategy visualization in February, data visualization also in February, our managerial leadership program, and then executive communication and leadership presence. You may contact me for information, and please do feel welcome to visit our website as well. And also, just again, thank you for joining us. Have a wonderful day. Happy New Year. We look forward to hopefully a really good year ahead. So take care, everyone.